Good morning. Hidden costs in mortgage and home buying and how to avoid them. And buying a home isn't just about the purchase price or interest rate. Many borrowers are surprised to discover thousands of dollars in hidden mortgage and home buying costs that surface late in the process or worse after closing. What's the good news? Well, most of these costs are predictable, negotiable, or avoidable when your loan is structured correctly. And here's a clear breakdown of the most common hidden costs and how smart borrowers reduce or eliminate them. Number one is closing costs beyond the loan estimate. So many buyers assume that closing costs are a flat number. And in reality, they're going to fluctuate based on the timing, property taxes, insurance, and lender structure. Not a one size fits all type deal. But some common surprises that first time buyers notice would be title insurance premiums, especially if they're expected to pay them, but also recording and transfer fees, especially when there's transfer taxes in some states, but also courier and settlement fees, or just your general lender admin or underwriting charge. So, how to reduce them? Well, a mortgage broker can compare lenders that waive or cap lender fees and time closings to reduce the prepaid costs. Two is escrow accounts and prepaid expenses. So escrow accounts are often cause the biggest sticker shock. In a closing, you may be required to prepay 3 to 12 months of property taxes and 6 to 12 months of homeowners insurance, as well as your initial escrow reserves. And these are not fees that are being charged to you, but it's basically real cash that's needed from you at closing to set up your escrow account. So how do you reduce it? Well, close just after a tax due date, so that way you have to escrow less. Shop insurance aggressively or work with a number of great insurers. And structure loans that allow escrow waivers when appropriate. Three is private mortgage insurance premiums. And PMI is required on many conventional loans with less than 20% down. But few borrowers understand how long they're stuck paying it. So it's a hidden cost. PMI can range from 0.3% to 1.5% annually, adding hundreds per month to your loan payment. So how do you avoid or remove PMI? Well, one, you can use a lender-paid PMI structure if your income's above the deductibility threshold. You could also consider single premium financed MI. Or you can use appreciation or renovation value to eliminate PMI early. Number four is property taxes and these supplemental assessments. So your first tax bill may not match what you were originally quoted. And why? Well, new construction has reassessments of the value that often occur after the sale, something to watch out for. But also if local bonds, MUD taxes, or special districts have recently been approved. So you could see supplemental tax bills after your purchase. So how to avoid these surprises? Well, a local broker reviews your true tax exposure and not just your current seller bills. We'll run a property profile report too. But number five is rate buydowns and discount points. Paying points can lower your rate, but only if you keep them long enough for it to make sense for you. So the hidden mistake is paying upfront costs to get that really pretty rate, but then you never break even on it. And the smarter strategy is match your rate strategy to expected holding period, your refinance plan, or your future income growth. Six is homeowners association or HOA costs. HOAs can often include transfer fees, capital contribution fees, and special assessments. And these are rarely disclosed until very late in the escrow process, so it can feel like a surprise. But how to protect yourself? Request your HOA documents early and often, and factor those fees into your cash to close analysis. Seven is the cost of choosing the wrong loan structure. And the biggest hidden cost isn't a line item fee, it's a bad loan design. So if you're overpaying interest due to a poor structure, you could be missing tax advantages, but also you could lose future refinance flexibility. And this is where working with a mortgage broker is going to outperform working with the bank. So the final thought is that transparency beats speed. And banks sell products, but brokers design solutions. And when you understand where the money actually goes, you make better decisions and keep more of your capital working for you. Now, if you want a full breakdown before you buy or refinance or build, work with somebody who shows you the full picture up front. And that guy is me. My name is Bill Rapp. Please visit my website, billrapponline.com. Love to chat with you more. You can figure out how to get hold of me there, and have a good day.